Philippine Mining Club and the Philippine Infrastructure and Construction Club are professional networking forums bringing industries together and creating opportunities for the Philippine mining and infrastructure and construction industries. Networking is about giving, not taking. It is about forming trust and helping one another toward mutual goals, regularly engaging with your contacts, and finding opportunities to strengthen relationships. Networking is a great opportunity to exchange best practice knowledge, learn about the business techniques of your peers, and stay abreast of the latest industry developments. Opportunities like partnerships, invitations to events, introductions, and giving talks and presentations bring challenges that benefit and feed your career, professional development, and personal interests. Gaining the advice of experienced peers is an important benefit of networking.
This is our business. It's where commitment is born. A personal stake in everything we do. Innovation and technical expertise at our core. Responsibility deeply felt. We are relentless, curious, trailblazing, transforming with purpose, helping communities connect, and people thrive, globally, locally. With energy, water, and urbanization made sustainable for generations to come. Because your community is our community. Your challenge is our challenge. And your world is our world. GHD, the power of commitment.
Unlock the power of deep sector coverage with S&P Capital IQ Pro. We're always thinking about the sectors that fuel the markets. Use the S&P Capital IQ Pro platform to access an unrivaled depth and breadth of sector-specific data, news, and research. Broaden your perspectives with asset-level data on the companies, industries, and markets that impact your business. From banking to energy, fintech to healthcare, there's coverage for every workflow. Standardized, reliable banking industry analysis on everything from international commercial banks to U.S. credit unions. Comprehensive analytical data on insurance companies across the globe to guide strategic and investment decisions. In-depth mining intelligence to identify business opportunities, evaluate the performance of mining companies, and track industry trends. To see the big picture, you need sector-specific insight. Discover your power. Search S&P Capital IQ Pro today.
Good afternoon, everyone, including our PMC and PMEA members, and of course our marketing partners. Welcome to the 15th PMC webinar. My name is Kevin, and I hope that you all have an enjoyable and informative time with us today. Just before I get going, I'd like to mention and thank our valued marketing partners, for without these companies' assistance, the webinars would not be possible. Our supporting partners are Major Drilling, Hexagon Mining, Mezzo Autotech, Imdex, Cruz Marcelo and Tenebrancia Law Firm, First Metro Securities, Ollie Consulting Group, and Resources Comms. Our foundation partners are Weir Minerals. Weir Minerals delivers end-to-end solutions for all mining, transportation, milling, processing, and waste management activities. Site Skills Training. Site Skills Training offers international recruitment and workforce solutions to companies in the mining and processing, oil and gas, and construction industries. Moving on to our principal partners, AUSTI Geophysical Consultants, advice and guidance for geophysical exploration programs being carried out in the mining and metal sector, as well as the coal sector. AUSTI Geophysical Consultants also provide a wide range of services to the environmental, groundwater, and engineering industries. Quest Exploration Drilling, Asia's leading exploration drilling company. Modern equipment with well-trained staff has elevated QED to become the benchmark for international sand and drilling operations in a terrain that is generally typified by logistical constraints and geological complexities and topographical extremes. GHD has had a permanent presence in the Philippines since 1998, with over 600 professional staff spread across 3 cities in the Philippines. Their main office is in Makati, and the 2 branches now in Cebu City and Quezon City. Focused on creating lasting community benefit, GHD leverages on its connected global network of 10,000 employees to provide engineering and environmental management services to key players in the energy and resources sectors. Prime BMD offers to their clients services for major infrastructure projects throughout the Philippines and Southeast Asia. Expertise, experience, and resources are applied across the industry sectors of transport, water, ports, resources, and the energy sectors. S&P Global Market Intelligence. S&P Global Market Intelligence integrates financial and industry data, research, and news into tools that help track performance, generate alpha, identify investment ideas, understand competitive and industry dynamics, perform valuations and asset risks. Their deep sector coverage provides a comprehensive view of the mining sector worldwide and connects you to global opportunities on a single platform. Sit on top of the fast evolving mining sector and evaluate opportunities and risks with essential data, analytic and insights, the most trusted global mining sector data, all in one place. That's the power of S&P Capital IQ Pro. And of course, our industry partner is OceanaGold. We thank them for their ongoing support. We're also affiliated with the globally recognised Melbourne Mining Club, ANSCHAM, the Australian New Zealand Chamber of Commerce, PMEA, the Philippine Mining Exploration Association, and COMP, the Chamber of Mines of the Philippines, PMCEE, the Philippine Mine Safety Environment Association, DEWATA, and EMCEE Philippines. And of course, our media partner is the Philippine Resources and Construction Journal. And now, ladies and gentlemen, I'd like to hand you over for the rest of your journey to Joan Falcatella, who will say a few words about our MC today. Thank you very much. Enjoy your evening with us.
Thank you, Kevin, and good afternoon, everyone. Ladies and gentlemen, may I say a few words about our MC today? Attorney Patricia Bunye. Attorney Patricia Bunye is Senior Partner and Deputy Managing Partner for Administration of Cruz, Marcelo, and Francia. She heads its Mining and Natural Resources Department and the Energy Practice Group. She is also a partner in the Intellectual Property Department. She is a past president of the Licensing Executive Society International, LESI, 2016 to 2017. The first Filipino and Southeast Asian to hold the position. She is also founding president of DEWATA Women in Resource Development Incorporation, a non-government organization that advocates responsible development of the Philippines' wealth in resources. She is an active member of the Chambers of Mines of the Philippines, Legal Committee, and is a columnist in the Philippine Resources Journal. She is in the 2021, 2020, 2019, and 2018 list of the Philippines' top 100 lawyers and has been cited various international law research publications such as Chambers, Legal 500, Asia Law, among many others. Ladies and gentlemen, I will now hand you over to our MC, Attorney Patricia Bunye.
Thank you very much, Joanne. Good afternoon, ladies and gentlemen. I'm happy to be back as your MC this afternoon. Before I proceed, I would like to highlight the following. We will be issuing certificates of attendance today, and you can request them from Ms. Joanne Falcatella. Her email address is joanne@philippineminingclub.com. For your questions today to our speakers, please type them in the Q&A or chat box below. Please indicate to whom you're addressing your questions. I will then read them out to our speakers after their respective presentations. And we will hold the Q&A after all the speakers have made their presentations. There will also be a quick survey at the end of the webinar today, so please answer it before you log off. And finally, before we begin, we would like to request everyone to please put your mics on mute at all times, except when it is your turn to speak. This is to avoid unnecessary noise in the background. As you will note, we have two topics this afternoon. Part one is a global outlook for battery metals and assessment of Philippine battery metals potential. Part two is a climate competitiveness lens on metals and mining. And I will begin by introducing all of the speakers. For the first part, our first speaker is Paul Manalo. Paul primarily works in the publication of the annual study of corporate exploration strategies responsible for the quality check of dataset as well as the estimation and forecasting of exploration budgets. He also writes research articles on various topics in the mining industry, from initial resources, exploration trends, and assay share price. Prior to joining S&P Global in 2015, Paul worked in a startup research company based in New York and Manila that created a platform that aims to forecast future performances of retail companies in North America based on their operational data. He holds a Bachelor of Arts in Philosophy, minor in Political Science from the University of the Philippines. Our second speaker is Eillen de la Cruz. Eillen is a research associate for the Metals and Mining Research Group in Manila. She primarily contributes to the annual data collection, analysis, and articles publications for the Corporate Exploration Strategies, or CES, involving estimated and forecasted exploration budgets. She also works on other topics, such as those related to initial resources, project milestones, and metal discoveries. Prior to joining S&P Global, Eillen worked as a junior geologist in the copper-gold project of the Silangan Mindanao Mining Company Incorporated site office in Surigao del Norte, Philippines. Her expertise included surface water mapping, drilling rigs, supervision, and hydrogeological observations. She is a licensed geologist and holds a Bachelor of Science in Geology from the University of the Philippines, Diliman. For the second part of our webinar, our topic, as mentioned earlier, is a climate competitiveness lens on metals and mining. We are pleased to have once again Patrick Lam, who, as you will recall, was our speaker last September 24. Patrick Lam is the Senior Commodity Specialist at S&P Global Market Intelligence based in Hong Kong. As part of the commercial team, he has been serving institutional clients in Asia Pacific with data research interest in the commodities markets, as well as solutions related to corporate development workflows for the past 5 years. Battery materials, renewables, and environmental impact data have been his growing spectrum of coverage, given the evolving market interest and firms. Prior to joining S&P Global, he worked their London and Singapore offices and with Smart Timing Steel, Iron Ore, and Steel Analyst. Patrick graduated with a Master of Science London and another Master of Science in International Banking and Finance from the University of Glasgow. His last thesis was about the financial valuation of a Russian iron ore project using the Monte Carlo simulation approach, given the volatility of macroeconomic assumptions. He will be joined later on the panel by Alice Yu. Alice is a senior analyst in lithium and cobalt for S&P Global Market Intelligence. She launched the Lithium and Cobalt Commodity Briefing Service Report in June 2020 and generates the monthly 5-year outlooks on the global electric vehicle, lithium, and cobalt markets. Her research spans across the lithium-ion battery value chain, including gigafactory capacity, battery choice mix, and technologies. Alice has specialized in battery metals research for the past 6 years, with 9 years of experience across commodities research. Prior to joining S&P, she led projects ranging from lithium company stock listing to coal market research and steel M&A analysis. Alice graduated with a Master of Science in Economic History and a Bachelor of Science in Economics, both from the London School of Economics. So let us begin now with part 1. And Paul, please begin now.
Hi, Can you hear me now?
Yes, we can hear you.
Okay, good. Hi, everyone. Good afternoon to each one of you who are watching us live today, and for those who will be watching this on demand. Let me just thank Atty. Patricia for the introduction, and of course the organizers, PMC and PMEA, and of course the sponsors for giving us the S&P Global Insights Commodity Insights team the opportunity to share some of our data and insights. By the way, our webinar presentation today is powered by S&P Capital IQ Pro. Our platform covers nearly 100,000 mining companies and more than 6,000 operating mines. In the last 12 months, we have published more than 10,000 articles. We provide monthly and annual coverages to important metrics in the industry, such as drilling, financings, exploration, discovery, among others. Okay, now, before we begin, let's take a look at the outline of our webinar this afternoon. Okay, we will begin by discussing. We will begin our discussion by understanding the ongoing global trend that puts sustainability in the center of many policies. Right after that, we will discuss some of the primary metals used in the global decarbonization effort, particularly copper, lithium, cobalt, and nickel. In the last part of our presentation, my colleague Eillen de Cruz will be presenting some interesting data and some analysis in regards to Philippine battery metals potentials. With that in mind, let's start our discussion. To begin, let's talk about the ongoing trend on sustainability and net zero. About 2.5 decades ago, only scientists were talking about the extent of the role played by greenhouse gases, GHG, to the warming of our planet. In my case, I think I was first exposed to this topic when we had a film showing in college to watch Al Gore's film entitled Inconvenient Truth. Maybe you've watched it. That was released in 2006. For most of the population, the warming of the planet is a new or foreign concept back then. However, in just a very short period of time, the discussion that started from scientific communities eventually moved to the mainstream with growing awareness from the public. They pressure national governments, international institutions to act and include net zero as a goal that they need to target. Net zero here, by the way, refers to the goal to achieve a balance between the amount of GHG produced and removed from the atmosphere. Okay, so in the left chart, we can see how major governments, US, EU, and then China, have revised their targets in the last couple of years to further reduce their emissions. According to a study of the Rhodium Group, the US, the EU, and China accounted about 45% of the global GHG emission. Most countries target 2050 as the target year to achieve net zero. In the Philippines, I believe we haven't set a target date for the net zero per se, although we have recently revised our target to cut GHG in 2030. From the original 70%, it was increased to 75%. Aside from public institutions, private companies are also doing their parts to contribute to this net zero goal. In the right-hand chart, S&P Global Sustainable One division surveyed more than 5,000 companies around the globe, and they have recorded a growing list of companies setting their targets for net zero. Being able to start earlier, European companies, the first bar, are quite ahead of the pack, with 60% of the companies surveyed saying that they had set a target emission for emission reduction. Companies in Asia Pacific region have the smallest share of companies that have announced a climate target. Okay, so moving on. In a study published in 2014, data showed that 39% of global GHG came from the transportation sector, accounting around 14%, and electricity and heat production accounting around 25%. This huge chunk is a key in reducing global GHG, simply because recent advancement in technology can drastically reduce GHG in these areas. The use of renewable energy such as solar, wind, hydroelectric, geothermal are viable alternatives for burning fossil fuels such as oil, coal, and natural gas to create electricity and power vehicles. As we can see in the right-hand chart, since late 2000, we have seen an uptrend in the use of solar energy as an alternative source of electricity. This actually coincided with the increase in efficiency of the panels and fall in the prices of these photovoltaic cells. However, the main challenge in the use of renewable energy production, such as solar and wind, is their intermittency, meaning the lack of solar power produced during nighttime or during cloudy days, or the lack of wind power produced when the wind is not blowing. The main solution to this is the use of energy storage technologies such as the hydropower plants, energy storage flywheels, and batteries to store excess energy from these renewable sources. Among these storage technologies, our team is very much interested in the utilization of batteries. This is because the manufacturing of these batteries requires special metals such as copper, nickel, lithium, and cobalt, among others. Okay, so let's try to zoom into the transport or mobility sector. Battery tech is the key to replace the use of internal combustion engines or ICEs. While battery-operated electric vehicles, BEVs, are almost as old as fossil fuels powered vehicles, the absence of an energy-dense way of storing this electricity or power hindered the mainstream use of ICE in the past. So, however, in recent years, the advancement in the density of batteries led by automobile companies such as Tesla and battery manufacturers such as Japan's Panasonic, South Korea's LG and Samsung, and China-based companies such as CATL and BYD, they enabled electric power vehicles to be feasible alternatives to oil-powered ICEs. However, it is important to note that electric cars are only as green as the source of the electricity. Using carbon-based fuel from power plants can limit the green potentials of these electric cars. Okay, so here in this chart, we can see a huge spike in the sale of PEVs, plug-in electric vehicles in 2021, wherein it more than doubled year over year. This is despite the chip shortage, elevated commodities prices, and various lockdowns all over the world due to COVID. We have forecasted that PEV sales from 2021 to 2026 will have a compounded annual growth rate of around 27%, with penetration rate expected to reach 23% in 2026, meaning almost 1 in 4 of automobile sales will be PEV. That's from around 3% in 2019. Okay, so governments are pushing for the transition towards EVs to meet their net zero targets. While China and Japan, I'm not sure if they haven't. I think they haven't set a year to phase out their ICE cars. However, China targets that in 2025, 20% of their total sales will be from EVs. While in Japan, 53 to 73% total sales are targeted to be from hybrid and EVs in 2030. Europe set a more aggressive target, setting the pace out of ICE cars in 2035. Here in the Philippines, the Electric Vehicle Industry Development Act was recently approved by the Senate and is waiting ratification by the lower house. This bill seeks to create a roadmap to grow the local EV market. Aside from that, the third tranche of the tax reform or train law implemented in 2018 has already exempted purely EVs from excise tax. More recent developments are the proposal of DTI and NEDA to totally eliminate the tariff or import duty on imported EVs that is currently set at 30%. Okay, just to put this into perspective, based on what I've read, if this push through the cutting of the tariff and other incentives, a BEV compact sedan, just like the BYD E2, with a range of around 300 to 400 kilometers that uses lithium ferrous phosphate blade battery, can be purchased at around 700,000 or around 14,000 USD. That is actually on par with the entry-level Toyota Vios with manual transmission that, as we all know, is very common here. Okay, so moving on. Let's go to the metals forecast. Okay, so this great transition will definitely require huge volumes of resources that include specific metals. As we've mentioned, topping the list are copper, nickel, lithium, cobalt, among others. By the way, these four metals are extensively covered by our group, the S&P Global Commodity Insights. Being an efficient conduit, copper is used in various renewable energy systems such as solar, wind. Copper demand is expected to increase to 929,000 tons in 2025 from this system. Copper is also the preferred metal to be used in induction motors, as well as those DC brushless electric motors, such as those found in modern EVs. Copper demand from EV use is expected to jump to 1.84 million tons in 2025. For the battery tech, various metals are being used with lithium, cobalt, nickel on the helm. Lithium became an alternative to lead, being a lighter and more reactive metal. Compounded annual growth rate for lithium from 2021 to 26 is estimated at 20%. Cobalt is mixed with lithium to increase stability, battery life, and density. Compounded annual growth rate for cobalt is estimated to be at 9% in the same period. Aside from being used as an alloying element to produce stainless steel, nickel is actually gaining traction in battery tech due to its capability to increase energy density and improve storage capacity. Compounded annual growth rate for nickel in the same period is estimated at around 6%. Okay, so now let's look at the price charts of these four metals. Okay, so metals prices bottomed few months after the World Health Organization declared that COVID-19 as a pandemic. The bull commodities market, which began in the second half of 2020, continued through 2022, with many metals hitting or flirting with historic highs, driven by supply deficit and difficulty in getting some of these commodities. The doubling in sales of PEBs in 2021 propelled prices of lithium to new highs, ending February at near 45,000, exceeding the previous highs in 2018 during the price rally brought by fear of lithium shortage caused by the electrification of mobility. In the case of cobalt have been supported by logistical disruptions in the port of South Africa that is used to export cobalt from the Democratic Republic of the Congo, or DCR, or DRC. Copper prices have recovered quite fast after prices bottomed in March 2020. In October 2021, prices have revisited its previous highs in 2011, fueled by supply concern caused by underinvestment in copper production pipeline the last decade, amplified by the general trend of increasing demand from what we said, the green initiatives, and of course the remaining or lingering issues caused by COVID-19. Just like copper, nickel has been trending upwards since its price has bottomed in March 2020. However, recent events in the invasion of Ukraine by Russia and the imposition of sanctions of major economies against Russia have pushed prices of nickel to new highs. A couple of weeks ago, there was a short squeeze in the LME and pushed prices to as much as 100,000 per ton. That's up by 250%. Okay. Moving on. Okay, so now with these elevated prices, we can only expect that the capital markets will grab this opportunity. The elevated metals prices have brought renewed interest from investors and, of course, the capital markets in general to finance exploration and expansion. In our team, we track key industry metrics such as financing, such as this, drilling activities, announcement of initial resources, among others in our monthly industry monitor report or series. We can clearly see that in 2021, funds raised for lithium and copper spiked as investors jumped in to take a slice to this booming commodity prices. Okay, so now after we have discussed some of the macro trends, we can move on to the discussion of the specific metals. Okay, so for copper, we can see in the left chart the increasing demand for copper due to net zero goals. Compared to 2017 to 2019, and the succeeding years, beginning 2020, actually saw a steeper increase in demand for copper. Aside from these, we can also expect further demand from the expansion of electric grid and upgrade of telecommunication infrastructure in many places, especially in the US and China. In the right-hand chart, we can see our forecast for the refined copper balance until 2026. The deficit in 2020 and 2021 were caused by the pandemic and affected almost all places, but it can be argued that the effects is worse in Latin America. That is home of some of the largest copper mines. The global energy crunch due to the rapid rises in the prices of fuel such as natural gas and coal amplified the deficit in 2021 and caused supply disruptions, pushing many companies or mines to cut their copper output. We have seen and continue to see lower copper stocks in major exchanges that we haven't seen in decades. In 2022, we forecast that the deficit will temper as inflation is expected to weigh on the global economy and temper the demand for copper. We anticipate some surplus in 2023 as we forecast drop in copper prices in the second half of 2022. As we expect mine copper production to increase in the midst of softer demand growth. Nevertheless, the Russia-Ukraine conflict and supply concerns that linger in Latin America will continue to weigh down copper supply, at least in the near term. We expect deficit to return in 2024 and increase until 2026. Okay, so in this chart, we have outlined the existing supply of copper concentrate and those that is on the pipeline, broken down on the likelihood of assets going online. Committed concentrates are from the assets that are not yet operating but have been able to secure funding and with recent mine developments. As we can see, beginning 2020, we have started to see demand to outpace the supply. Demand continues to grow while current and committed supply remain virtually flat or flattish from 2023 to 26 and start to fall until 2030. Even if we factor probable and possible projects, those blue and yellow shaded chart that are these. By the way, these are the projects that are less likely to operate in a given year compared to committed assets. We expect that demand will still outpace supply beginning 2028. Okay, so now with this, next slide, please. Okay, so with this not so optimistic or rosy picture of copper supply in the near and medium term, I think it's worth checking the reasons for such deficit. One factor that we are looking at is actually in the exploration sector. Okay, so in the left chart, we can see the exploration budgets for copper from 1997 to 2021. By the way, this data is lifted from the Corporate Exploration Strategies study that we publish annually. It is one of the main offerings of our group, wherein we survey more than 2,500 companies each year around the globe for their exploration plans. Beginning 2003, as you can see in the chart, we have seen sharp and continuous increase in budgets for copper exploration, supported by elevated prices of copper until it was disrupted by the global financial crisis. However, copper exploration budgets managed to recover and even trended higher until 2012. Copper budgets peaked at 4.7 billion in 2012 as copper prices exceeded the $4 per pound mark. After peaking in 2012, prices began to fall as demand from China slackened, and this was amplified by uncertainty due to fear of defaults in some countries in Europe. Since it peaked in 2012, copper budgets continued to plummet as prices of the red metal found its bottom until 2016, While copper exploration budgets have seen an uptrend since 2017, as prices starts to recover, budgets haven't really revised the previous highs or revisited the previous highs in 2011 and 2012. Copper budgets in 2021 increased 30% to 2.3 billion. It's just half of the previous highs, even though the previous prices have been revisited already. Okay, so closer examination of our data shows that COVID-19 restrictions in Latin America that historically accounts the largest copper explo budgets in terms of region dragged down the global copper budgets. In other places such as Canada, Australia, and the US, growth in copper exploration budgets were actually much higher. Okay, so now focusing on the right chart, aside from the generally lower exploration budgets for copper, we also saw this trend of decreasing focus on grassroots or early stage exploration. From 1997 to 2005, early stage exploration took an average of around 56% share of the budgets. In the succeeding years until last year, 2021, the share of early stage exploration decreased to 36%, or just above 1/3. With mine site share gaining traction over the years. While this can be attributed to the natural progression of some assets, moving from early stage to feasibility and of course eventually construction or expansion, we've been seeing this risk-averse attitude among explorers and producers as they focus on less risky and less rewarding assets or deposits that located in proven areas, rather than taking a risk on new areas in the midst of lower commodity prices in the past. Okay, so moving on. Now, this lesser focus on greenfield projects affected announcements, initial resource announcement, and of course discoveries. For copper-denominated initial resources, the number of announcements in the last 5 years averages to just 9. This is compared to around 20 in the period of 2012 to 2016. This is also the case for discoveries, as you can see in the right-hand chart. This is one of the reasons that we estimate further deficits in copper supply in the succeeding years, and that's caused by the underinvestment in copper exploration in the past. Okay, so now we're done discussing copper. Let's move on to lithium and cobalt. Okay, so as we have discussed earlier, lithium is a major component of the mainstream battery tech, that is lithium ion. Lithium ion battery tech typically accounts around 30 to 40% of the typical price of a BEV, battery electric vehicle, making them the costliest component. Due to being a more recent metal compared to others, let's have a quick discussion about lithium as a metal. Okay, so according to USGS, brines are saline groundwaters that are enriched with dissolved lithium. The picture on the left shows the Salar operation in Argentina. This is a picture that shows brine being pumped to the surface and dried using solar evaporation. So lithium salts will remain after brine water evaporates within a number of months. Most brines are concentrated in the lithium triangle area in the Latin America region, particularly Chile, Bolivia, and Argentina. There are also some operating brine assets in China, although Chinese brines usually incur higher capex due to higher magnesium content compared to brines in the lithium triangle. For lithium found in hard rock deposits, the one on the right, lithium-rich minerals are hosted in pegmatites. The hard rock lithium mines are like any other base metal mines, where ore can be mined from an open pit or an underground mine and transported to the processing plants. Hard rock deposits are scattered around the globe, although Australia is the leading concentrate producer. Lithium can also be extracted from lithium clays, that's also referred as soft rock, although it is not as common as brines or hard rock. Okay, so after that, let's move on. Okay, so let's move on to how lithium and cobalt is used as a major battery component. Okay, so lithium is used as a cathode. The cathode part of the battery determines the capacity and voltage of the lithium-ion battery. In the opposite side, the graphite is often used as an anode. Lithium is mixed with various metals such as nickel, cobalt, manganese, iron, etc., to alter characteristics such as capacity, life cycle, stability, and cost. In the left-hand chart, we can see various chemistry that are widely used today. However, we can just focus on the two major chemistries that are widely used today. First is the nickel manganese cobalt, NMC. NMC has increased nickel content at the expense of cobalt. The shift to a more nickel intensive batteries has been driven by the cobalt's higher costs and supply concentration risk, as well as nickel's ability to increase battery energy density. Cobalt is a controversial material due to its source. It is very much concentrated in the DRC. That accounts for around 70% of the global mine supply. It's tainted by ethical and humanitarian issues such as child labor, hazardous artisanal mining, crime, corruption, among others. That's why many companies such as Tesla are trying to find ways to limit the use of this in batteries. The second type of cathode chemistry is the use of lithium ferrous phosphate, LFP. LFP batteries does not contain nickel or cobalt. LFP batteries are actually cost-effective choice for entry-level BEVs, electric buses, and utility storage application, due to its cost being around 4 to 5 times lower compared to the counterpart, the NMCs. Although there's a trade-off, of course, in the capacity, or in the case of the EVs, the driving range. In the right-hand side chart, we can see the huge spike in the share of LFP in 2021 and steady growth in share in the medium term. The growing share of LFP can be attributed to the deployment of LFP of major BEV players such as Tesla and Volkswagen in their portfolios. The Tesla Model 3 built in Shanghai in China already shifted to LFPs, while they continue to use NMC for higher tier models to maximize the range. Car companies are diversifying their battery portfolio due to the rising cost of NMC due to shortage of battery-grade nickel. Okay, so now moving on, let's move on to the supply and demand. Growing demands for battery pushes supply deficit for the second straight year in 2022, after years of surpluses. For lithium, market tightness will remain at least until the first half of 2022. There are some supply increases we're expecting from various mines that we'll expect to start beginning mid-2022 and early 2023. Thus, we can expect a little surplus in 2023, although it's going to be very thin and it's going to be highly dependent on the announced time frame of some expansion plans. Supply deficit expected to balloon after 2023 and expected to jump to 100,000 tons in 2026. For cobalt, logistical disruptions in South Africa will continue to support prices, at least in the first half of 2022. We estimate prices to correct in 2022 as we expect supply chain bottlenecks to ease, coupled with the startup of the Mutanda mine from mid-year. Although cobalt share in battery chemistry is expected to decrease, the ramp up in PEV sales can offset this cobalt thrifting in batteries. A stronger supply ramp up through 2024 will sustain a market surplus during the period, pressuring prices. We also expect cobalt market to see a deficit in 2025 to 2026, supporting the price to bounce back. Okay, so lastly, the elevated prices of lithium and cobalt and its strong fundamentals attracted many companies to pursue lithium and cobalt exploration. While exploration for both lithium and copper did not go back to pre-pandemic level in 2021, unlike nickel and copper, it's most likely caused by the price rally of lithium and cobalt happening at the later part of the year. And that may be too late for some companies to revise their exploration plans. However, with elevated price, we can only expect junior companies to grab this opportunity to this renewed lithium rush. We're also seeing a trend that the larger producers or majors are including lithium and cobalt assets in their portfolios, as evidenced by the major growing share of the budgets for these metals. In the right-hand side chart, we can see the funds raised for lithium and cobalt and in 2021 and how it dwarfed the funds raised in the previous years. Okay, so that concludes my part of the presentation. To continue our discussion and tell us more about nickel and the prospects of the Philippines in the battery metals mining sector, let me give the floor to my colleague, Eillen de la Cruz. Eillen?
Hi, everyone. Thank you very much, Paul, for discussing the first part. And thank you, Attorney, for the introduction earlier. So now let's tackle the last part of this macro view on battery metals before we proceed to the discussion on the Philippine setting. So let's discuss nickel. On the demand side, we expect the global primary nickel demand to rise at 8.4% compounded annual growth rate over the next 5 years. Now, this rapid increase will be an effect of the increasing adaptation of electric vehicles in the market. As for the supply side, the one on the right-hand chart, the major factor at play here is the quote-unquote Indonesian nickel rush. So this might be led by the anticipated expansion of Tsingshan's nickel output. So as we all know, Tsingshan had its successful initial production in December and the delivery of converted nickel pig iron or NPI to nickel matte in February. So even before these successes, Tsingshan already has plans of expanding its operations. And so this underpins our expectations for Indonesian primary nickel production to grow by a compounded annual growth rate of 15% over the next 5 years. And so that would result to Indonesia accounting for over 50% of the global primary nickel output in 2026. And you can see that on this right-hand chart. Next slide, please. So due to the projected nickel production growth in the next few years, particularly in Indonesia, the global primary supply is expected to rise faster than demand between 2022 and 2024. This would result to surpluses in the near term. We can see that at work in the right-hand chart. So our current forecast from the Commodity Briefing Service or CBS for nickel suggests that the global primary nickel market will move to a 34,000 tons surplus in 2022 from an estimated 181,000 tons deficit in 2021. So this just shows that the current market tightness would ease as the Indonesian primary output further expands. And as a consequence, this will pull down the LME 3-month nickel price from its current high level. Now, further out into the future, we see production staying relatively stable and retaining the surplus, but demand is expected to catch up with primary supply. So this would lead to diminishing balances that could support nickel prices from $19,000 to $20,000 per ton in the next few years. Now, this shrinking surplus, especially beyond 2024, might call into question the sufficiency of nickel in the pipeline that can sustain the EV industry growth and the overall future rise in nickel demand. So next slide, please. For that, we can take a look at the discovery rates for nickel in the past decades. So nickel discovery has been very prolific, especially in the 1990s, but it has been dwindling since the 2000s. Now, there are very few discoveries on the record in the recent decade. You can see that on that graph. And this can be attributed to lowered spending for greenfields exploration. So right now, exploration companies are preferring the less risky near mine programs more. So next slide. And you can see that exploration trend in the left side graph. So in the past decade, the companies have shifted their focus from grassroots exploration to mine site exploration. So you can see that towards the end of the recent decade, there is a large bulk of the exploration budget dedicated to mine site exploration. However, if we see the change in 2020 and 2021 budgets there is a sizable increase in budgets for early stage nickel exploration. And that increase was actually more significant than the increase in mine site exploration. So if that trend for grassroots exploration is sustained, we might see new discoveries that can soon be developed into mines. But until we see vigorous grassroots exploration again, the discovery rates for nickel might remain as is. And the last thing that I want to discuss here is the exploration budget for per country. So currently, Australia and Canada altogether account for 60% of global nickel budgets. Both countries have trends of increasing allocations to grassroots exploration, which is gradually catching up with their budgets to mine site programs. Now, it's worth noting that both of these countries have financial incentives in place for mineral exploration, and these help maintain interest in exploration activities, particularly to nickel. Now, we also see top producers in this chart. We see Indonesia, we see Russia, China, and of course the Philippines. Although on a global scale, the Philippines rank at the far top 10 in terms of nickel exploration budgets. Now, I know you're eager to hear what the Philippines has in the context of battery metals. And so with all these points in mind, let me now walk you through the discussion zoomed into our local setting. So the discussion about the Philippine status in the context of battery metals will essentially have three main parts. The first part is the analysis on historical data. The second part is the current status of the country in terms of reserves, resources, productions, and projects. And the third part would be the forecasted performance of the Philippines in the metals industry, particularly for copper, nickel, and cobalt. So again, let me start with an overview of the country's exploration budgets. So you can see in this graph that exploration in the Philippines has been dwindling in the past decade. And this is largely due to some government policies that hamper the development of mining industry in the country. So in 2004, we had EO or Executive Order number 270, which promoted the revitalization of mining in the country. And you can see the impact of that policy in the next coming years. So you see a sustained growth in exploration budgets from 2004 up to 2008, when the Great Recession hit the economies, and that resulted to a year-on-year decline from 2008 to 2009. But after that, the exploration budgets quickly picked up and reached a peak in 2012. So by that time, by 2012, the exploration budget to the country was at $1.3 billion, and we accounted for 25% of the total exploration in the whole Pacific region. Now, on that same year, however, the then administration passed EO 79, which included an imposition of a moratorium on granting new mineral agreements. So that ultimately put downward pressure on the mining industry, particularly on generative exploration. And so we see the budgets declining since that year. Soon after, we had the Department of Environment and Natural Resources, or DENR, ordering the closure of several metallic mines and imposing a ban on open pit mining in 2017. And that resulted to budgets shrinking to its present levels. So since then, exploration budgets have been struggling to recover. A bit of a good news, I think, is that in 2021 we had positive developments in the mining industry. So the open pit mining ban was reversed, and the 9-year moratorium on new mining deals was lifted. So currently, sorry, can we go back to the previous slide? So currently, as of the latest exploration strategies or CES analysis, the allocation for mineral exploration in the country is at $32 million from 19 budgeted companies. This is 11% higher than in 2020, but is still well below than the 2012 high. And currently, we only account for 10% of the exploration in the Pacific region. Now, I've mentioned a while ago that some of the government policies constrain generative programs, and you can see their effects in this chart. So the budgets for the early and late stage exploration declined since 2012, and explorers shifted their preference to mine site exploration. Now, if you look at the area chart on the right-hand side, you would see that that preference to mine site exploration became more pronounced in the country since 2018, when near mine exploration accounted for as much as 70 to 80% of the total exploration budget. So in 2021, grassroots exploration in the Philippines even went down by 56%, while late stage and mine site exploration both increased year over year. Now, this could have an implication on the industry in the long run, as we know that lower spending for generative programs like early stage projects means there would be fewer discoveries and initial resource announcements. Next slide, please. So if we look at exploration targets, gold continues to be the primary focus, which has been the trend in the past decade. But actually, before 2011, it was copper exploration that was dominant, and the focus was mostly on early and late stage development. In the past 10 years, however, exploration for copper has been declining. Nickel exploration was also in a downward trend in the first half of the recent decade, with only marginal increases in the years 2018 to 2020. So as of the latest, copper, nickel, and cobalt exploration altogether accounts for only less than a quarter, less than 25% of the annual exploration budget in the country. So before I leave this slide, I would just like to note that for the sake of simplicity, I will from here on refer to copper, nickel, and cobalt altogether as battery metals. So now that we've seen the trends in the past years and how mining companies responded to various stimuli in the industry, it's time to investigate the current status of the Philippines in context of battery metals. So starting with reserves and resources. So the Philippines is currently one of the main producers of nickel in the world. So it's no surprise that we also rank among the top countries in terms of nickel reserves and resources. So the Philippines ranks fourth next to Russia in nickel reserves and resources. We have 31.4 million tons. In terms of nickel reserves, we outrank all countries. So we have the most nickel reserves globally at 10.5 million tons. But we know that our nickel deposits are usually low grade and they average at 1.17% nickel in reserves. So it's for this reason that the nickel we produce and or export are usually not high grade enough for battery manufacturing. So they're instead used in the production of stainless steel or nickel alloys. And so there. However, Tsingshan's technological breakthrough, as I mentioned before, can expand the source of battery-grade nickel to include NPIs. And although that development was met by questions and concerns about cost, environmental impacts, and others, it definitely provided a starting point on more diverse opportunities for low-grade nickel consumption in the future. So I mentioned that we have substantial nickel reserves, and that is an impressive fact. But if you bring your attention to the right-hand chart, the part of the chart where you have diagonal lines, so the striated part, you would see that 53% or more than half of the total reserves in the Philippines is hosted in projects that are currently inactive. Additionally, we have this bright orange chunk here that shows 17% of those reserves are still in the late stage development. So what these numbers convey is that we have a lot of underdeveloped deposits that we can consider in the future if we plan to grow our nickel supply to help address the increasing global demand. Now, if we look at copper, we have a story that is a bit different. So in terms of reserves, we fall behind the global rankings. We have 5.3 million tons in reserves, which is far from major supply contributors like Chile and Peru. In reserves and resources, we have 46.4 million tons. Now, unlike nickel, only a little portion of copper reserves are currently in active projects. But the more noticeable fact here on the right-hand side is the bright orange area, which means that we have 60% of copper reserves in projects that are still in the late stage development. So this also means that we have a lot of reserves in our arsenal that we can further advance to add more copper to the supply pipeline. So looking at cobalt reserves, we rank fourth globally, albeit far from the main producer DRC. So far, all of the cobalt reserves that we have are in active projects, but most of the resources are in inactive projects that are still in the late stage development. So there we had the overview of the reserves and resources. Let's now look at the country's production data. So we are among the top producing countries of nickel and cobalt, while we lag other countries in copper production. We are in the far second next to the primary producer Indonesia in terms of nickel production. We are in the far fifth place globally in cobalt production, and we are in the 31st place in copper production. Now, according to MGB in its recently released year-end report, the metallic mineral production value in 2021 grew by 20% year over year from 134 billion to 161 billion. MGB is also optimistic for 2022 as there were new mines to enter production recently. So from that standpoint, we are doing good on the production side. Now, what about the status of metallic projects? So last February 28th, MGB released an updated list of EPs or exploration permits and MPSAs or mineral production sharing agreements. So according to MGB's latest tally, most existing exploration permits are for gold-dominated projects, and only a quarter are for nickel and copper-dominated ones. For exploration permits with pending renewal applications, so the internal portion of the graph on the left-hand side, only 38% are for nickel and copper exploration. Now, looking at the recent number of MPSAs on the right-hand side, almost half are for nickel and copper projects. And out of all these MPSAs, those with commercial operations only account for 24%. Now, if we look closer at nickel and copper projects that have commercial operations, so next slide, please, we would see that most of the existing nickel projects, MPSAs, are in commercial operations. Almost half of the MPSAs for nickel, in fact. The rest is mostly focused on exploration and development. Now, the opposite is true for copper projects. So on the left-hand side, the left bar, we see that the MPSAs are dominated by projects still in exploration and development. So this means we have a lot of copper projects that can contribute to the supply pipeline, although we can only expect few projects to possibly go online in the near or medium term. So one is the Silangan project in Surigao del Norte, and the other one is the King project in Compostela Valley. So just a brief context, those two projects are the second and third most valuable copper projects in the country next to the Tampakan mine. Now, on the right-hand side, we see that most copper and nickel projects classified as with commercial operations are active. So that's it for project statuses. Now let's look at the market profitability gauge of mining in the country. So the all-in sustaining cost, or AISC, is a cost framework that provides a picture of a mine's profitability. So in our platform, the S&P Capital IQ Pro, we have the cost curve tool, which is a charting tool that has features to modify multiple cost curves across a wide range of commodities. It includes the flex model that allows the user to customize macro-level economic indicators. So in this slide, we see the all-in sustaining cost curves for nickel and copper mines in the Asia-Pacific or APAC region. So we modify the chart to produce country-level cost and use consensus forecast scenario made by our analyst. So on the left-hand side, the all-in sustaining cost for nickel mines in the Philippines averages at 489.53 cents per pound, which is lower than the APAC region average. So this is the 2021 average, by the way. Now, our country's AISC has been lower than the regional average since 2010, when nickel production increased by 15 tons from 2005, making up for Japan's dropping numbers. On the right-hand side, we have a different story for copper AISC in 2021. It plotted above the regional average. However, the AISC of those copper mines is projected to decline this year, and much of that dip comes from significant decreases in sustaining capex, electricity, fuel, labor, and reagent costs. So now that we've had a background on the country's historical exploration trends and our current position in the battery metals context, let's now look at what's in store for the Philippines in the near term. So both copper and nickel production are expected to remain strong in the country in the near term. S&P Global Commodity Insight estimates that in 2023, copper production in the country will grow by 44% to 79,000 tons, while nickel production is expected to grow by 10% to 435,000 tons. It's not included here, but cobalt production is also forecasted to increase by 19% to 4,700 tons in 2022. Now, some factors supporting this growth in the near term are number one, the lifting of the moratorium on new mining deals and the reversal of the open pit mining ban. So this will result to increased production and possibly exploration activities. Whether we will see a continuity of these policies or not will depend on the succeeding administration after the elections. Number two, NGB just recently announced that there will be a dozen new mines to go online this year and that they are mostly nickel dominated. So those are also expected to beef up production for nickel. So we see production in a positive growth up to 2026. But as mentioned before, beyond that year, there is a looming fear of shrinking surplus globally, um, especially when the demand for battery metals overpowers the forecasted tightening supply. So for that reason, next slide, please. The untapped reserves and resources that we have in the country are worth revisiting. So this is the final slide. And I just want to emphasize the comparison between the reserves we're currently utilizing versus those that are underdeveloped, particularly for nickel and copper. So more than 2/3 of the nickel and copper reserves are still in active, are either still in active reserves development or just sitting idle. So the realization of this potential might ultimately come down to number one, implementation of supportive mining policies, and number two, effective environmental regulations. So to conclude, we've established that there is a clear and strong trend of shifting towards cleaner technologies to lessen our carbon footprint, and this trend will continue to support the market price for battery metals. Now, the demand for battery metals will be driven by the developments in battery chemistry choice. And meanwhile, in the Philippines, we are expected to have a strong and growing production numbers in the near term. And we have so much metal reserves in active projects that provide us with significant potential that we can develop to contribute to the supply pipeline. So that's it for the first part, Attorney.
Thank you so much, Paul and Eillen. You have given us comprehensive information to consider. I'm really looking forward to the discussion in the Q&A. So audience, please begin putting your questions in the chat and Q&A boxes. Now I'd like to call on Patrick Lam, Senior Commodity Specialist at S&P Global Market Intelligence, to give us part 2 of the webinar on a climate competitiveness lens on metals and mining. Patrick?
Hi, everyone. Thank you for joining today's session of our discussion for climate competitiveness lens on the metals mining industry. I'm Patrick Lam, the Senior Commodity Specialist of S&P Global Market Intelligence, and I will be your presenter today on these topics. So for the agenda today, we'll quickly introduce climate-related risk and the relevance of climate risk for the mining industry. Then we'll explore a case study analysis on greenhouse gas and sample gold mines. Finally, we'll look at some practical examples of utilizing the metals and mining data from S&P Global Market Intelligence, as well as the metals and mining climate competitiveness data from S&P Global Sustainable One. Next one, please. Next one, please. Without further policies to combat climate change, the OECD projects that greenhouse gas emissions will grow by about 52% by 2050. This would raise the global temperature by about between 1.7 to 2.4 degrees Celsius, comparing to pre-industrial levels, at least twice the temperature increase as we've seen between 1899 and year 2005. Amid all, one thing is certain: as the world addresses these global challenges, companies and investment portfolios are expected exposing to rising climate change transition and physical risk. To begin with, let's review the global asset holdings of the company constituents under S&P 500 index. On the map here, S&P 500 companies hold physical assets across 68 countries. Almost 60% of those are located at areas highlighted in red, which indicate high physical risk. amid climate change. The most significant physical risk for these S&P 500 companies are associated with heat waves, wildfires, and hurricanes, while some sectors, particularly those with high capital and water-intensive sectors, may be disproportionately at risk, including the mining sector. The exposure of individual companies might be determined by the location of each company's operational asset holdings. Next, please. Now, climate-related policies like carbon taxes, emissions trading schemes, and fuel taxes are expected to feature prominently to address climate change. The current challenge is that carbon prices may be relatively low. So S&P Global Sustainable 1 research showed that carbon prices may need to increase to around about $120 per ton on average by 2030 to achieve Paris alignment scenario. Nevertheless, this price level may vary depending on the sector and geography. The visualization in front of us, we can see that the potential increase in carbon pricing across the globe with countries in Central and South America, as well as certain parts of Asia Pacific, likely to be most impacted. Mining assets, as well as the investors, may be exposed to unpriced carbon risk if they operate in locations where carbon prices are likely to increase sharply. In summary, companies will be increasingly exposed to climate change, physical, and transitional risk, and might be impacted differently based on the geographical distribution of their assets. Next one, please. The mining sector as a whole consumes about 1.25% of the global energy. So this statistic is as at 2017. The energy demand is expected to rise by 1/3 at 2035, mostly because of the increasing demand of industrial metals, particularly those illustrated by my colleagues earlier. The sector, of course, is carbon intensive. The production of 4 major mine commodities, which include iron ore, copper, aluminium, and gold, produce about 2% of the global industrial carbon emissions. Today, we'll discuss the major climate-related risk to highlight the key issues faced by the mining sector, namely water stress, unpriced water risk, and unpriced carbon risk. The process of mining and ore beneficiation consumes a lot of water. Water is a key climate-related physical risk because changes in the water pattern can possibly bring material shocks in the water availability, hence affecting the cost of water in the form of extraction costs or local water tariffs for mine operations. Using 300 global copper mines in our sample data analysis, we examined the relationship between the total amount of water consumed in the water basin and the water available in the same basin for mine operations. Through the quantification of the water scarcity risk called Water Risk Index, we identified mine operations that are most vulnerable to water stress. In the right-hand chart, regions with dark red are areas with water risk index above 0.8, which are classified as extremely high water stressed. Chile, for example, has the highest water risk reading of almost 12 in our data sample, hence indicating that the copper mines there may consume 12 times the available water in the same water basin. In Australia, certain areas in New South Wales and the Murray-Darling Basin present higher water risk index reading than the rest of the country, given the data sample. Unpriced carbon risk refers to the potential increase in carbon prices if the market were to price in the emissions to reach 2-degree scenario at a certain year. In this example, we analyzed carbon emissions data from 93 gold mines across 31 countries. These are mines that have disclosed their Scope 1 and Scope 2 carbon emissions. The total carbon risk is a function of the mine level carbon emissions and the projected carbon price required for the world to meet the 2-degree scenario. The left-hand chart indicates that South African gold mines in our data sample present the highest potential rise in carbon prices, average at about 23%. If such risk were to price in by 2025 as part of the mine site cost, this is mostly due to the relatively high greenhouse gas intensity for each ton of ore treated at South African gold operations. In comparison, the data sample for Australia indicates a relatively low 5% unpriced risk by 2025. Surely the evolving market attitude towards 2-degree attainment may change these percentage estimates over time and present uncertainty to our data analysis. Besides greenhouse gas intensity at mine level, the right-hand chart presents the potential rise of unpriced carbon risk itself, extending to year 2030. For example, in the case of Australia, the steeper slope coefficient indicates a relatively aggressive rise of unpriced carbon risk over the longer term, reaching over $100 per ton of CO2 equivalent by 2030. Talking about mine level greenhouse gas intensity, our metals and mining research team from S&P Global Commodity Insights reviewed 2020 sustainability reports from more than 90 leading gold mines globally to conduct a year-to-end comparison of greenhouse gas emissions. Throughput from these sample gold mines fell about 1%. Meanwhile, emissions from these operations decreased less than 1%. Emissions intensity averaged at 0.697 ton CO2 equivalent per ounce of gold produced, a negligible decrease year over year. The left-hand chart shows the varied distribution of greenhouse gas intensity across mining methods globally. Open pit mines exhibiting a higher intensity on a per ounce of gold produced basis, but a lower intensity on a per ton of ore processed basis. Based on the sample data, a global leader in emissions intensity change was Russia. On a per ounce basis, Russia's average emissions intensity was down 24% year over year. Actual emissions fell between 18% and 58% at 4 of poor use operations. In comparison, for example, in Asia Pacific in Australia, the data sample indicates a relatively modest 5% increase in greenhouse gas intensity. In comparison, the US operations record a whopping 28% year-to-year rise. Barrick's Nevada operations joint venture with Newmont is by far the greatest emitter in the United States. On all throughput basis per 1,000 tons, Australia, in comparison, also record a modest 2% year-to-year rise among the data sample. These two charts in front of us compare the greenhouse gas intensity at mine level amount per ounce basis on the left and all throughput basis on the right. Though there exists a degree of nuance within the data regarding the reasons behind the increased emissions intensity, the most important factor is the ore grade. Grades at open pit mines were higher year over year, which contribute to the decreased emissions intensity per ounce of gold produced. With emissions decline faster than ore throughput year over year, the intensity per ton of ore processed declined 1%. However, at underground mines, there was a significant decline in the grade of ore processed from an average 3.25 grams of gold per ton in 2019 to 2.64 grams per ton in 2020. Emissions increased by more than 2% at those mines, but with less gold produced per ton of ore processed, emissions intensity on a per ounce basis increased much more. Next one, please. Combining the mine level data from S&P Global Market Intelligence and the environmental data from S&P Global Sustainable One, the Metals and Mining Climate Competitiveness Dataset intends to equip our users conducting climate-related risk analysis at mine level. The dataset covers about 1,400 mining assets across 78 countries, around 15 commodities. The dataset extends the modeling coverage of carbon price data for 56 countries, water risk data from 15,000 water basins, and environmental data disclosure from 120 mines as applicable. In cases where disclosure is not available, we'll deploy our in-house environmental model methodologies to estimate the emissions and water consumption of those mines, taking into account the different production intensity of those commodities. Next one, please. With this data set, our team create a number of data matrix that hopefully will be able to equip our users with climate-related risk analysis faced by the mining industry and financial institutions that continuously evaluate the industry player performances. Next one, please. A quick glimpse of the data set is a set of company scorecards. Here, we have taken this fictional mining company called Mining Incorporated. There are two parts of the scorecard. The upper part shows an organizational view of climate risk summary. And then on the bottom half, it looks at individual mining assets covered by the dataset. The table shows the potential increase in mine site cost, given the expected rise in unpriced carbon risk, unpriced water risk, and the commodity alignment score, given its commodity production mix to give mine level climate competitiveness score. Please get in touch with our team if this were of interest. Thank you for your participation today and look forward to speak soon. Thank you.
Thank you very much, Patrick. We'll now proceed to the Q&A. Paul, Eillen, and Patrick will be joined by Alice Yu, who is a senior analyst in lithium and cobalt for the S&P Global Market Intelligence. So prior to today, we received some questions also in advance. And one of the questions was, does the Philippines have available resources of lithium and cobalt? And if so, where are these ores found in the country? I think Eillen extensively discussed cobalt, but do we have lithium, Eillen?
We don't have any available resource on lithium. So Paul mentioned a while ago that we have two kinds of lithium resources. We have pegmatitic lithium, the hard rock lithium, and the brines. So the pegmatitic lithium, they're usually associated with granites. And although we have granites here in the Philippines, it's not that abundant, and we have a different magmatic chemistry as well that doesn't permit the formation of lithium here in the Philippines. We also don't have lithium brines. They're mainly found in select regions in the world, such as those with closed basins in arid regions. So we don't have lithium. But we have cobalt, so I mentioned that a while ago, and they're usually found in areas where we have ophiolites. So those are areas with cobalt. What's the term? We have cobalt deposits there, and then they can also be found in nickel cobalt laterites. So currently we have cobalt resources in Zambales. So in Zambales, we have our ophiolite complexes there. We also have ophiolite complexes in Palawan. So we have deposits in Palawan. We have a few in Region 13. We have one in Agusan del Norte, one in Surigao del Norte. We have one in Region 10 in Misamis Oriental, and one in Mimaropa, so in Mindoro Occidental. So I hope that answers the question.
Thank you, Eillen. The next two questions are more global in outlook. And I'll ask them together. Does the world have enough reserves to meet the increase in global demand for copper, lithium, cobalt, and nickel? And then the other question is, what are the majors doing in terms of lithium and cobalt? Maybe Alice would like to weigh in on these questions.
Yeah, maybe I'll start, and I think Paul has some contributions on what the majors are doing. So in terms of whether the world has enough resources, if we look at the absolute numbers, then yes, there are ample reserves for most commodities. But then if we look into detail, there are issues. So we looked at copper, and then as Paul mentioned, copper has faced underinvestment for some time. The number of quality copper assets available for development is quite low on a global level. That's when you look at reasonable grade, the reserve base, and expected cost. Many are also facing permitting issues and local community pushbacks. And the bulk of the copper reserves are deposits that were discovered decades ago. So they are either already in production or have stored for one reason or another. And that's why beyond the near term, the copper market is facing a looming deficit due to a lack of a pipeline. For nickel, there are enough reserves, but there's a stark division between the laterite oxide reserves and the sulfide reserves. Oxide reserves are plentiful, but they're more challenging to convert into these class 1 nickel, which has typically been the type of nickel that has gone into battery nickel sulfate production. There are efforts to produce class 1 or battery grade nickel from oxide ores, and Indonesia is leading that, but it's still challenging, and the commercial viability is still slowly proving itself. And in general, the sulfide ores are also more scarce, and that's why people haven't been developing those. For lithium, there are a lot of reserves, especially in the lithium brines, which Eillen mentioned, but brines take a long lead time. They also need a lot of space to build evaporation ponds. So it's also an issue of permitting. And the lithium brines, a lot of, for example, in Chile, there are lots of lithium brines, but they extract groundwater in the desert, which is already very dry area. So there are also issues around water usage. One path forward is the development of direct extraction techniques, which skips pond evaporation, but that's relatively novel technology. So across copper and nickel and lithium, there are challenges with bringing the reserves into production. And then on the issue of what the top producers are doing, I'll pass over to Paul on that.
Thanks, Alice. Juniors remain to be the dominant group for lithium and cobalt exploration. By the way, this is in terms of exploration. However, we've been seeing a new trend wherein majors are gaining interest in these specialty metals. Like for example, in our data, from just around 10% in 2017 share of the global budgets for lithium and cobalt, the majors share increased to around 27%. Closer analysis of our data shows that companies such as Rio Tinto and some Chile-based producers, namely Codelco and Soquim, are pouring resources to explore lithium. So yeah.
Maybe I'll add one more point to, since Paul raised Rio Tinto, like of the majors, so Rio Tinto, BHP, Vale, and Anglo, so on, their efforts in lithium they're just not as in the lithium market as companies smaller than them. Rio Tinto has kind of led the majors in lithium, but they've also saw pushbacks in Serbia, but they've recently acquired an asset in Argentina, which shows commitment in lithium. But so far, these players are not strong in the market. Thanks.
Alice, you mentioned the lack of a pipeline for copper, but right here in the Philippines, in our backyard, we have the Tampakan project, but so many obstacles have been put in its way. It's very unfortunate.
Yes, copper is a key commodity, especially in the green transition, both in electricity generation, distribution, and renewable generation, and also in electric vehicles. It's the potential shortage of copper will really weigh on the global transition to net zero.
Yes, we're on our last 5 minutes, and I think one burning question, of course, you cannot discount, the geopolitical scene. There are concerns that the current Russia-Ukraine conflict will affect the demand for these battery metals. How would you address that? Any one of you would like to comment?
Maybe I'll start off and feel free to chip in. So the foremost implication on the commodities market has been a surge in the LME nickel price since the invasion and the LME prices surged to record highs in the first part of March. Prices have corrected, it's still volatile, but overall prices are higher than the level in February. So the fear of high nickel prices is on the NMC, the nickel manganese cobalt battery chemistries, which Paul mentioned in his presentation. That chemistry is a key component of the EV chemistry choice. Car makers use increasingly higher nickel intensive NMC chemistries to deliver higher drive range, and that will help alleviating range anxiety. You know, you can drive longer in your car, and that's a key attractiveness of using EVs over traditional vehicles. So high nickel prices has caused concerns of a potential move away from this technology route. But so far, based on our analysis, because battery metals prices across the board has increased so much, and in Paul's slide, we saw that lithium prices rose the fastest. Actually, the increase in lithium prices has been the biggest component and driver of battery metals costs, even when accounting for the much higher nickel price in the first part of March. And there's also no clear benefits or alternatives of switching away from the high nickel battery route. For one, the usage of nickel was encouraged to offset cobalt usage because of the political and the geographical concentration of cobalt, and that cobalt is more expensive than nickel, and having more nickel also benefits the drive range of cars. And then also there is no clear technological alternative. The other choices you'd have will be the LFP chemistries, which does not contain nickel or cobalt, and that right now has lower range, and it has worse low temperature performance, which isn't as an issue in the Philippines, but elsewhere, for example, in North America or Europe, the low temperature performance is quite key. So we remain watchful on the implications of nickel prices, if that will mean removing some of the key growth drivers in nickel demand. The current stance is that the high nickel route won't change, but all really depend on how the nickel price moves and how volatilities play out.
Mm-hmm. Okay, on that specifically, one attendee asked in the Q&A box whether the nickel production forecast to 2026 is based on operating mines only, or are new mines assumed to start in this period?
So for the nickel forecast, it was actually done in the first few days or first week of March. So it wasn't able to factor in the announcement by MGB, which was the new dozen mines to go online this year. So hopefully we will see that reflect on the next month. So we do these forecasts. We do adjust these forecasts every month. So probably those upcoming mines would be reflected in the forecast production next month. So to answer the question, for the forecasted production in nickel, we do not include only operating mines, we also consider those that are going online in the next few years.
Okay. Next, given all the information, do you think we can confidently push for the establishment of an EV battery manufacturing plant in the short term, meaning in the next 1 to 5 years?
I mentioned in the few slides before we ended the presentation, the part one a while ago, that it will boil down to the government policies that will take place, especially after the elections. So I also saw a question a while ago about um, the geopolitics in the Philippines that might affect the battery metals industry in the Philippines. And from what I know, the candidate leading in the polls right now is for sustainable mining, but his stand is not quite. It's big. It's not quite pro. It's not quite against, but it's pro for sustainable mining. As for the candidate in the second place in the polls, she's against the lifting of the open pit ban and the moratorium on new mining deals. So it will really depend on on the government policies going forward. Um, Realistically speaking, um, we are yet to develop our reserves. So it's not an overnight process. Unfortunately, it takes years. So with all these in mind, I think it's a really big step if we would like to um, establish an EV manufacturing plant here in the Philippines in the near term.
Thank you, Eillen. And this will be our last question, and I believe it's addressed to Patrick. Any trend on process seen in Australian mining industry to reduce GHG emissions?
Yeah, that's a very relevant question. We do see that Australia's largest mining companies are showing a heightened urgency to lower or reduce their greenhouse gas emissions and reduce their waste by pressing local suppliers to scrap some of the older equipment and lower the carbon footprint of their trucks. Some of these companies include Rio Tinto, PHP, FMG. They do scrutinize the carbon footprint of some of their suppliers' equipment as part of their own ESG governance accountability. We do see that the miners have made progress in reducing the global share of the emissions to 2.8% in 2020, down from 3.4% in 2016, but the companies still face intense pressure from customers and investors to shrink their carbon footprints and improve their sustainability. I think some part of these questions also, relate to equipment would be about how to make the value chain of this equipment greener. For example, when we talk about some of the mining trucks, at the mine site, how to recycle some of the mining trucks after the use life, and also, a lot of the, the equipment in place. That's, requires a lot of engineering solutions to move huge amount of logistics economically. And finally, some of the new initiatives would be utilizing renewable energy at some of the Australian mines featured by FMG. So we do say it's happening, but of course, there's a lot of engineering and also logistical issues are concerned.
Thank you, Patrick. I know that you all have many other items to discuss with our speakers this afternoon, but we have limited time. I'm sure they'd be happy to receive your questions by email, so you can forward them through the Philippine Mining Club. And Paul, Eillen, Patrick, and Alice would be happy to answer them for you offline. But for now, we have some reminders for you, including that there will be a brief survey at the end of this webinar, so please don't log off without answering it. And Job will be flashing that on the screen. But while that is being done, I'd like to remind you first that for those who need them, there will be certificates of attendance, and they can be requested through Joanne Falcotella at joanne@philippineminingclub.com. And there will be webinars on April 29 That will be with Mr. Ian Fraser, CEO for Asia Pacific of GHD. The details are on your screen right now. On May 27, with Mr. Robert Gregory, Managing Director of Celsius Resources. You will see the details just in a bit. There you go. And I'd like to thank you all for being here today and for your continued support of the Philippine Mining Club. So as always, we will take a photo of all the participants. Could you please turn on your cameras? There's the survey on your screen. Before we take the photo, please answer it so that we can provide this valuable feedback to S&P Global Market Intelligence.